somewhere in a vault. Tons of gold that took years to accumulate just vanished from the balance sheet, sold in a matter of weeks by a government that had no other choice. And once you understand why, you will start looking at every other struggling economy on the planet in a completely different light. For the better part of 5 years, the financial world was fed one dominant narrative. Central banks across emerging markets were quietly stacking gold, bar after bar, ton after ton, and the story that came with it was dramatic. Analysts, commentators, and self-styled financial prophets insisted this was a coordinated retreat from the United States dollar, a slow-motion rebellion, a group of nations preparing to dethrone the world's reserve currency and build something new in its place. It sounded compelling. It sounded like the beginning of a new global order. But in early 2026, that story began to unravel in the most unexpected way possible. And the unraveling started with a G20 economy that had spent years playing the exact same accumulation game everyone else was playing. That economy hit the panic button. In roughly 2 weeks, its central bank offloaded more than $8 billion worth of gold reserves. This was not a calculated trade designed to capture profit at a market peak. This was a government scrambling for liquidity, moving with the kind of urgency that only shows up when survival, not strategy, is the priority. And what followed was even more staggering than the initial sale. Let's slow down and walk through exactly what happened, because the sequence of events tells you almost everything you need to know about where the global financial system actually stands right now. At the close of February 2026, a central bank in a major emerging economy sold off close to 58 tons of gold, worth an estimated $8 billion, in a span of only 2 weeks. That kind of velocity is almost unheard of for a sovereign gold sale. Central banks typically move slowly and deliberately when it comes to their reserves, because sudden large sales can spook markets and signal weakness to the rest of the world. But this was different. By April of the same year, the total amount sold had climbed to roughly 128 tons. To put that figure into perspective, this single nation had liquidated an amount of gold equal to almost 40% of everything every emerging market central bank combined had purchased throughout all of 2025. One country in a matter of months undid nearly half a year's worth of collective global accumulation. This is what makes the story so significant. Central banks do not treat gold the way an individual investor treats a stock portfolio. They are not chasing quarterly gains. They are not trying to time a market top. Gold sits in a sovereign reserve for one core reason. It is the last resort. It is the emergency exit that a nation only uses when every other door has already been sealed shut. When you see a government running toward that exit, it tells you the pressure behind the scenes has become unbearable. So what pushed this economy to that point? The answer starts with its currency. And to understand a currency collapse, you first have to understand what a national currency actually represents on the world stage. A currency is essentially a trust signal. It reflects how much confidence the rest of the world has in a country's ability to manage its economy responsibly. Nations that are viewed as stable, transparent, and fiscally disciplined tend to attract steady streams of foreign investment, and that steady demand keeps their currency strong. The United States dollar and the British pound are textbook examples of currencies that benefit from decades of accumulated trust. But when that trust erodes, the opposite happens. Investors pull their capital out, demand for the currency drops, and its value begins a downward slide. This kind of erosion is typically triggered by a combination of factors: excessive money printing, ballooning debt levels, political turbulence, and persistent inflation. In the case of this particular economy, all of those pressures converged at once. Years of aggressive monetary expansion, a steady erosion of central bank independence, chronic inflation, and deep structural deficits combined to send its currency into a prolonged and painful decline. The numbers illustrate just how severe that decline became. Back in 2020, this nation's currency was worth roughly 14 US cents per unit. By 2026, that same unit of currency had fallen to a little over 2 cents. Currencies fluctuate constantly, and dips are a normal part of global finance, but this was not a normal dip. This was a multi-year free fall that reached historic lows in 2026, and a collapse of that magnitude does far more damage than simply making imported electronics more expensive at home. It fundamentally changes how a country is able to interact with the rest of the world. As the currency weakened, the country's international trading partners grew increasingly reluctant to accept payment in it. Instead, the world wanted dollars, as it almost always does when trust in a local currency evaporates. But here's the brutal irony: the weaker the currency became, the more expensive it was to actually acquire those dollars. In 2020, it took roughly 7 units of the local currency to buy a single US dollar. By 2026, that number had ballooned to nearly 50 units per dollar. Every transaction with the outside world had become dramatically more expensive, and the gap kept widening. Over time, this dynamic quietly drained the country's foreign currency reserves. Its economy weakened further, inflation accelerated, and even the most optimistic international investors began looking elsewhere. Still, somehow, the nation managed to hang on. It absorbed the pain, adjusted where it could, and avoided a full-blown crisis. Then something happened that had nothing to do with its own domestic mismanagement, and everything to do with a geopolitical shock nobody could have fully planned for. A war broke out in the Middle East, and in the aftermath of military strikes involving Iran, one of the most critical shipping corridors on the planet was effectively blockaded. That corridor, the Strait of Hormuz, carries somewhere around 1/5 of the entire world's oil supply. When it became compromised, oil prices surged almost overnight, sending shockwaves through every energy-dependent economy on the planet. Every nation felt some level of impact from that surge, but the pain was wildly uneven. The countries that suffered the most were the net energy importers, meaning the nations that rely heavily on buying oil and gas from abroad because they lack sufficient domestic production of their own. Our struggling economy fell squarely into that category. Despite having a sizable industrial base and G20 membership, it possessed almost no meaningful domestic oil or natural gas production. Nearly all of its fuel supply came from neighboring producers, and virtually overnight, every barrel of that imported fuel became dramatically more expensive for wealthier, energy-independent nations. This shock was manageable. Countries with substantial domestic oil reserves and production capacity like the United States were able to lean on their own supply chains to soften the blow. Prices still rose and consumers still felt the pinch, but there were safety valves in place. Other nations with diversified energy strategies found ways to limit the damage as well. Our featured economy, however, had no such cushion. It was hit with skyrocketing energy costs at the exact moment its currency was at its weakest point in modern history. The longer the conflict dragged on without resolution, the higher oil prices climbed, and the deeper the crisis became. Global energy markets do not negotiate. They do not offer discounts to struggling economies, and they do not accept excuses. They move fast. They are unforgiving, and critically, they operate almost exclusively in U.S. dollars. There was no workaround, no clever financial maneuver that could sidestep this reality. If the country wanted to keep its lights on, its hospitals running, and its transportation networks moving, it needed a massive influx of dollars, and it needed them immediately. The stakes here were not abstract. Failure to secure enough dollars to pay for energy imports would have meant power outages across millions of homes, hospitals losing critical operating capacity, transportation grinding to a halt, and supply chains for food and essential goods breaking down entirely. This was not a matter of economic discomfort. It was an existential threat to the basic functioning of the nation. With foreign currency reserves nearly exhausted and no international lender stepping in to offer relief, the central bank turned to the one significant asset it still had in reserve, its gold. And this is where the story becomes genuinely fascinating, because it forces us to reconsider everything we thought we understood about why countries accumulate gold in the first place. No central bank wants to actually tap into its gold reserves. Those reserves exist as a symbolic and practical backstop, a form of financial insurance that ideally never gets used, but when every other option has been exhausted, gold stops being a passive symbol of stability and becomes an active tool for survival. Those gleaming bars sitting quietly in a vault were suddenly the only thing standing between the nation and total financial collapse. So the decision was made. The gold had to move. This single decision is what begins to dismantle one of the most popular financial narratives of the past several years, and it's worth taking a moment to really unpack why. For years, a compelling and dramatic theory circulated across financial media. Emerging economies were stockpiling massive quantities of gold, not for defensive purposes, but as an offensive weapon aimed squarely at the United States and the dollar's global dominance. Proponents of this theory pointed to a loose coalition of nations, often grouped under a well-known economic alliance, and argued they were building enormous gold reserves specifically to engineer a new gold-backed global currency. The goal, according to this narrative, was to challenge the dollar's supremacy, weaken the broader American economy, and eventually force the entire world into an alternative financial system built outside of Western institutions. It was a gripping story. A quiet, coordinated financial revolution playing out behind closed doors aimed at ending the era of dollar dominance once and for all. But as 2026 has demonstrated, reality has taken a very different path than the theory predicted. The evidence undermining this narrative is not confined to a single country. This particular economy was simply the first and most dramatic example, but it is far from the only one. Data emerging throughout early 2026 shows that multiple other nations, including some that belong to the very alliance often cited in the de-dollarization theory, have also begun liquidating meaningful portions of their gold reserves. One major economy within that alliance broke a record that had stood for more than 2 decades, selling off more gold in a single month than it had in any comparable period since the mid-2000s. That nation has been grappling with the enormous financial strain of an ongoing military conflict and facing the very real prospect of deeper economic instability. It too turned to its gold reserves as a source of emergency liquidity. Other emerging market economies have quietly followed a similar path, executing smaller but no less telling liquidations of their own. Meanwhile, 2 of the largest economies within that same alliance have remained conspicuously silent about their gold-related activity, offering little public transparency into whether they are buying, holding, or selling. None of this behavior aligns with the idea of a unified offensive strategy against the dollar. If these nations had truly banked their gold reserves as a weapon meant to destabilize Western financial dominance, why would so many of them be selling off hundreds of tons of it the moment real economic pressure arrived? The honest answer is far less dramatic than the conspiracy narrative, but arguably far more important for understanding how the global financial system actually functions. The gold accumulated by dozens of nations over the past decade was never designed to be a weapon. It was designed to be a shield. These reserves function as financial lifeboats, built by governments and central banks that understood at a fundamental level just how fragile their domestic economies really were. Leadership in these countries recognized that their currencies could fail, that global shocks could hit their populations harder than wealthier nations, and that having a tangible, universally trusted asset in reserve could mean the difference between weathering a crisis and collapsing under it. So they accumulated as much gold as they reasonably could, not to attack anyone, but to protect themselves. That protective shield is now being tested in real time, and in some cases it is failing to hold. This particular nation's shield had more cracks in it than most, which is why it was the first to break under pressure. But the underlying dynamic at play here is not unique to one country or one region. It is only a matter of time before similar pressure builds and similar decisions are made across other struggling economies in Africa, Asia, Latin America, and beyond. The specific triggers will differ from nation to nation, just as the currency collapse looked different in each case, but the outcome tends to rhyme. Reserves accumulated for protection eventually get consumed when protection is no longer enough. It's also worth understanding the actual mechanics of how a modern sovereign gold liquidation works, because it is rarely as simple as loading physical bars onto a cargo plane. When this central bank needed dollars urgently, it did not physically ship its gold reserves overseas for a direct sale. Instead, it engaged in what is essentially a gold for currency swap. The bank pledged its gold reserves as collateral to major international bullion institutions. In exchange, those institutions wired billions of dollars directly into the central bank's accounts. Think of it like an individual who has significant wealth tied up in investments and property, but suddenly faces an urgent cash need. Rather than liquidating those long-term assets outright, they might take something valuable like a car or a piece of jewelry to a high-end lender and use it as collateral for immediate cash. If their financial situation improves, they can repay the loan and reclaim their asset. If it doesn't improve, the lender keeps the collateral permanently. That is essentially the arrangement this central bank entered into. The gold theoretically remains recoverable, but only if the country can repay the borrowed funds plus accumulated interest within the agreed terms. Given the scale of the economic pressure this nation continues to face, reclaiming that gold may prove significantly more difficult than losing it was in the first place. And here lies the deepest irony of this entire situation. For years, financial commentators insisted that stockpiling gold was a strategic move designed to help nations escape dependence on the U.S. dollar and undermine its global dominance. Yet when a genuine crisis finally arrived, this nation was forced to hand over its gold specifically to obtain the very currency it was supposedly trying to break free from. This wasn't the opening chapter of a new global financial order. It was a stark reminder that when conditions become truly dire, the world still overwhelmingly defaults to the currency it has trusted for generations. What unfolded in this economy is not an isolated event that we can simply file away as one country's unique misfortune. It is a warning signal about the broader condition of the global financial system. A major G20 economy was forced to liquidate its most valuable long-term reserves just to keep basic energy infrastructure functioning. It had to break the glass on an emergency fund that took years of disciplined accumulation to build, not to expand its economy or fund ambitious new projects, but simply to keep factories operating and homes heated through the winter. That is not a sign of a healthy Well-functioning financial system, that is a sign of a system operating under severe strain, one grappling with a genuine shortage of global liquidity that most everyday observers have not yet fully grasped. This nation is not likely to be the only example of this dynamic playing out. If energy prices remain elevated and the U.S. dollar continues to hold at its outsized influence over global trade and settlement, this exact scenario is likely to repeat itself with increasing frequency across other vulnerable economies. Nations already burdened by mounting debt loads, weakening currencies, and limited access to international credit markets may find themselves facing an identical choice in the coming months and years: protect their gold reserves and risk economic paralysis, or sacrifice those reserves to buy themselves time. This is the uncomfortable reality underlying the entire gold accumulation trend of the past decade. The narrative many were sold, that this was building towards some kind of coordinated new financial world order, simply does not match what is actually happening on the ground. Instead of a triumphant new system emerging to challenge the dollar, we appear to be witnessing the early stages of a much more difficult and widespread reckoning. The gold rush of the late 2010 seconds and 2020 seconds does not appear to be culminating in liberation from dollar dependence. It increasingly looks like it is culminating in a painful, prolonged adjustment period, one where the safety nets so many nations worked years to build are being reluctantly and repeatedly torn open out of sheer necessity. The first dominoes have already started to fall. Reserves that were meant to be untouchable emergency backstops are being converted into short-term survival funding, one country at a time, and the global financial system, rather than expanding its room to maneuver, appears to be running increasingly low on flexibility, just as pressure from energy markets, currency instability, and geopolitical conflict continues to mount simultaneously. For anyone watching the gold and silver markets closely, this story carries significant weight. It reframes years of aggressive central bank buying not as an aggressive challenge to Western financial power, but as a defensive scramble by economies that quietly understood their own vulnerability long before the rest of the world caught on. It also raises an important question worth sitting with. If one G20 nation was forced to unwind a substantial portion of its reserves within a matter of months, how many other central banks around the world are currently facing similar pressure behind closed doors, simply managing to avoid the headlines for now? The relationship between gold, currency stability, and global energy markets has rarely been more visible than it is right now. What we are watching unfold is not simply a story about one struggling economy making a difficult decision under pressure. It is a live demonstration of how interconnected today's global financial system truly is, where a conflict thousands of miles away can ripple through oil markets, crush a currency that was already struggling, and ultimately force a sovereign government to liquidate reserves it spent years painstakingly building. As we move further into 2026, it will be worth watching closely whether other nations follow a similar trajectory, whether more central banks quietly begin unwinding their own reserves, and whether the broader narrative around de-dollarization continues to lose credibility as real-world events unfold in the exact opposite direction that theory predicted. The gold market has always been a mirror for global confidence, or the lack of it, and right now, that mirror is reflecting something far more sobering than a triumphant challenge to dollar supremacy. It is reflecting genuine, widespread financial fragility hiding just beneath the surface of the global economy. If there is one lesson worth taking away from everything happening in the gold market this year, it is this: reserves built during calmer times exist precisely for moments like these, and when nations start reaching for them, it rarely means things are going according to plan. It typically means the plan has already failed and survival has taken its place. Keep a close eye on how this story continues to unfold, because the pressures driving this particular crisis, unstable currencies, expensive energy, and shrinking access to dollars, are not confined to a single region. They are global in scope, and the coming months may reveal just how many other economies are standing closer to that same emergency exit than anyone previously realized. It's worth stepping back for a moment and placing all of this within a longer historical arc, because sovereign gold buying sprees are not a new phenomenon. Central banks have cycled through periods of accumulation and distribution for as long as gold has functioned as a reserve asset. What made the 2022 cycle stand out was the sheer scale and speed of the buying. Emerging market central banks added gold to their vaults at a pace not seen in generations, and much of that buying accelerated sharply after major Western economies began freezing and restricting foreign reserves belonging to sanctioned nations. That moment served as a wake-up call for dozens of governments who suddenly realized that reserves held in foreign banks denominated in foreign currencies could be frozen, restricted, or seized entirely based on political decisions made thousands of miles away. Gold, by contrast, offered something those foreign-held reserves could not: physical possession and a form of value that does not depend on the goodwill of another government. That realization is what fueled years of aggressive accumulation. It wasn't a plot to dismantle the dollar. It was a lesson in self-reliance learned the hard way, and for a while it worked exactly as intended. Nations built up substantial cushions of gold, diversified away from single currency exposure, and gave themselves a broader set of tools to draw on if a crisis ever arrived. The problem is that a cushion is only useful if the crisis that eventually arrives is smaller than the cushion itself. In the case of this particular economy, the combination of currency collapse and an external energy shock proved to be larger than the safety net could absorb, and that is precisely why the gold had to move. This dynamic also has meaningful implications for the silver market, which tends to track gold's broader sentiment while responding to its own unique set of pressures. Silver has historically played a dual role in the eyes of investors and institutions. It behaves partly as a monetary metal, moving in loose correlation with gold during periods of financial stress, and partly as an industrial commodity tied closely to manufacturing demand, electronics production, and the ongoing build-out of renewable energy infrastructure. When central banks make dramatic moves with their gold holdings, it tends to ripple through investor sentiment across the entire precious metals complex, silver included. In this instance, the sovereign gold liquidation created a fascinating tension in the market. On one hand, a wave of large-scale gold selling from a major economy might typically be expected to pressure prices downward, at least in the short term, simply due to the increased supply entering circulation through the bullion banks involved in the swap arrangements. On the other hand, the underlying reason behind the sale, a currency collapse combined with a geopolitical energy shock, is exactly the kind of macroeconomic instability that historically drives private investors toward gold and silver as protective assets. These two forces have been pulling in opposite directions throughout the year, and the result has been a market that feels unusually turbulent even by the standards of a metal known for volatility. Silver in particular has faced its own layer of complexity. Industrial demand for silver has remained resilient, driven largely by its essential role in solar panel production, electric vehicle components, and a wide range of electronics manufacturing. That steady industrial appetite has provided a floor underneath silver prices, even as sovereign-level gold sales introduced uncertainty into the broader precious metals landscape. At the same time, retail and institutional interest in silver as a monetary hedge has continued to grow, particularly among investors who view the metal as a more historically undervalued alternative to gold. This combination of industrial resilience and growing monetary interest has kept silver in a somewhat unusual position throughout this period of sovereign gold turmoil, neither fully insulated from the broader uncertainty nor fully at the mercy of it. For everyday investors trying to make sense of all this, it's important to separate two very different stories that often get blended together in financial commentary. The first story is about long-term structural demand for gold and silver, driven by central bank diversification, industrial usage, jewelry demand, and growing retail interest in physical precious metals as a store of value. That structural demand has not disappeared, and in many respects it remains intact even after this year's dramatic headlines. The second story is about short-term liquidity events like the one this particular nation experienced, where a government is forced to sell reserves not because it wants to, but because it has run out of alternatives. These liquidity-driven sales can create short-term volatility and headline-driven price swings, but they don't necessarily reflect a change in the underlying long-term thesis for precious metals. Understanding this distinction matters because it's easy to look at a headline about a central bank selling off tons of gold and assume that institutional confidence in the metal is fading. In reality, the opposite may be closer to the truth. The fact that gold was the asset of last resort, the one thing valuable enough and liquid enough to save an entire economy from an energy-driven collapse, actually reinforces just how important precious metals remain within the global financial system. Nations don't turn to assets they consider worthless when facing an existential crisis. They turn to the assets they trust the most. This entire episode also raises important questions about how other central banks around the world are quietly managing their own reserve positions behind the scenes. Not every nation facing economic pressure makes headlines the way this one did. Many governments manage currency and reserve challenges through quieter channels, smaller incremental sales, extended credit arrangements, bilateral currency swaps with allied nations, or simply drawing down foreign currency holdings before ever touching their gold. The dramatic, headline-grabbing nature of this particular sale stemmed largely from its scale and speed, but it's reasonable to assume that smaller, less publicized versions of the same underlying pressure are playing out across multiple economies simultaneously, particularly among nations with heavy energy import dependence and fragile currencies. Looking ahead, there are several dynamics worth watching closely if you want to stay ahead of where this story goes next. The first is the trajectory of global energy prices. As long as geopolitical tensions in major oil-producing regions remain unresolved, energy costs are likely to stay elevated, and that pressure will continue to fall hardest on nations without substantial domestic production capacity. The second is the pace of central bank gold buying and selling more broadly. If additional major economies begin reporting similar liquidations in the coming months, it would strongly reinforce the idea that this is a systemic liquidity issue rather than an isolated national crisis. The third is the ongoing conversation around currency diversification and the dollar's role in global trade. Even as the de-dollarization narrative takes a significant hit from episodes like this one, the broader, slower-moving trend of nations seeking alternatives to dollar dependence has not vanished entirely. It has simply revealed itself to be a far more gradual and complicated process than the dramatic headlines of recent years suggested. There's also a broader lesson here about how financial narratives take shape and spread, one that extends well beyond gold and silver markets specifically. Dramatic, simplified stories tend to travel faster and further than nuanced ones. The idea of a coordinated global rebellion against the dollar made for compelling headlines and even more compelling video content, but it consistently oversimplified what was actually a much more mundane and defensive behavior pattern among central banks. Real-world events like the one we've walked through today have a way of exposing which narratives were built on solid analysis and which were built primarily for engagement and attention as viewers and as investors, staying grounded in what the actual data shows, rather than the version of events that generates the most dramatic headline, tends to be the more reliable path forward. None of this means gold and silver are any less important to watch going forward. If anything, this entire situation underscores just how central these metals remain to the functioning of the global financial system, even in an era dominated by digital currencies, complex derivatives, and increasingly sophisticated financial instruments. When the pressure becomes severe enough, when currencies fail and energy bills come due, governments still turn to the same physical assets that have anchored value for thousands of years. That's not a sign of an outdated financial system. It's a sign of just how enduring and reliable these metals have proven to be across centuries of economic upheaval. As this story continues to develop throughout the rest of 2026, expect more nations to face similar pressure points. Expect continued volatility across both the gold and silver markets, and expect the broader conversation around de-dollarization to keep evolving as new data comes in. The safety nets built over the past decade are being tested in real time, and how they hold up or fail to hold up will likely shape the next major chapter in global financial history. Make sure to stay tuned for continued coverage as more central banks reveal their reserve positions in the months ahead, because if this year has taught us anything, it's that the real story in the gold market rarely matches the version that gets the most attention when it's first being told. Before wrapping up, it's worth reflecting on what this moment really represents for anyone who follows precious metals closely, whether as an investor, a trader, or simply someone trying to understand the broader forces shaping the global economy. Sovereign gold sales of this magnitude do not happen in a vacuum. They are the visible tip of a much larger iceberg made up of currency stress, energy dependence, debt accumulation, and shrinking policy options across dozens of economies that rarely make international headlines. The nation at the center of today's story happened to be large enough, and the sale dramatic enough, to capture global attention. But the underlying pressures driving that decision, expensive imported energy, a weakening currency, and limited access to dollar liquidity, are shared by a long list of countries that have not yet been forced to make the same choice. That's precisely why this story matters far beyond the borders of a single nation. It offers a preview of a pattern that could easily repeat itself as global energy markets remain volatile and as more governments find themselves squeezed between rising import costs and weakening domestic currencies. Watching how central banks respond to that squeeze, whether through gold sales, currency swap agreements, emergency borrowing, or some combination of all three, will likely be one of the more important financial stories to track over the remainder of this decade. For those following the gold and silver markets specifically, the takeaway is not that central bank demand is disappearing or that the long-term case for precious metals has weakened. Quite the opposite. What we are witnessing is a reminder of just how deeply gold remains embedded in the architecture of global finance, serving as the ultimate backstop when currencies fail and conventional options run dry. The difference this year is that we are finally seeing in real time and in striking detail exactly how and why that backstop gets used when a genuine crisis arrives. That's a lesson worth remembering the next time a dramatic new narrative about central bank gold buying starts making the rounds.